I'm Ed Ludlow in San Francisco. Caroline Hyde off today. This is Bloomberg Technology. And coming up, tech stocks drop as a hot jobs report adds pressure on the Fed to keep raising rates. Plus, warnings from Amazon and Alphabet weigh on shares as big tech gets hit by the slowdown. Even so, the Nasdaq 100 rises for a fifth straight week as Apple gains. And the cyber attack, which sent derivative trading back to the 1980s, we've got the Bloomberg scoop on how vulnerability at a little-known software firm led to some brokers going manual. But first, we've got to talk about these markets. A really hot jobs print for the month of January, putting pressure on the Fed to look at raising rates. That's the market take on all of this. And then we digest earnings. The Nasdaq 100 down 1.8%, although, as we said, it ended the week up on the week, meaning 5 straight consecutive weeks of gains. This Philadelphia Semiconductor Index also kind of in line with that, down 1.9%. As yields continue to push higher, Bitcoin essentially did nothing in reaction to what we saw from the data. It kind of traded sideways at around $23,500 per token. There's still momentum in the earnings story in both directions. Switch up the boards and look at the names that we're thinking about, particularly Apple. It was so interesting because the post-market reaction Thursday to Apple's miss was negative, and yet we're up 2.5%. There was some optimism around what Tim Cook had to say on reopening in China. Not so for Alphabet, the parent of Google, or Amazon. Those shares really dropping and then accelerating their declines following that hot job sprint. Of course, their earnings were not impressive to investors, worrying signs about the trajectory for 2023, which we'll get into. And then Meta, it actually had been higher, continuing its momentum from its earnings that beat earlier in the week. But then we had that jobs print as well. And that's where we got to go, because the focus on data is back. The focus on the Fed is back. So Bloomberg's Reed Pickett joins me from out in D.C. Reed, hit me with the numbers that we got from the Ecosphere on Friday.
Well, first of all, I'm always here to report good economic news, so that's a great way to end a Friday. But what we saw that employers added about 500,000 jobs in January, which blew past estimates, and it was this really broad-based gain that really kind of showed this re-strengthening in the labor market when we didn't really know it could get any stronger. So you saw the unemployment rate fall to 3.4%, which is a 53-year low. We saw this broad-based hiring. We saw the average work week tick up, showing that there's still kind of that robust labor demand. And we saw wages, while decelerating from the prior month, we saw them still continue to climb at a robust rate.
Reed, you're the only person that I know that can go through all of that with such beaming joy on a Friday after what has been a busy day in markets, volatility driven by the numbers. Here I am, broken and exhausted. You just keep going. Fine, let's go with it. I think that the narrative, as I framed it, we go back towards the Fed, right? Good economic data, bad news for markets. And that's because of what we think the Fed will now have to reconsider. What is the market saying about the Federal Reserve in response to the numbers that we have on the screen?
So especially whenever you get a number like today, in the wake of other strong data that we've seen, you saw job openings rally back above 11 million. You've seen jobless claims, so applications for unemployment, you've seen them fall in the last 4 out of the last 5 weeks. You've seen kind of this sustained strength in the consumer. It really makes the Fed's job more difficult. And, you know, some of my colleagues had a great story out today about how when you see jobs numbers like today's, it, really strengthens the Fed's resolve to, push rates above 5%.
All right, Bloomberg's Reed Pickett, just fantastic reporting on that eco data that's Friday. I want to hone in on the tech sector and put it in the context of job cuts, all of those that we've seen, particularly in 2022. Bloomberg's MLive team has been asking if these cuts have been too large, too small, or even too premature. Here's what some of Bloomberg Television's guests have had to say about that question.
Even after all of the recent layoffs that you've seen for many of the large tech companies, we still see tech as, relatively bloated in terms of if you look at how much its, employment counts have grown relative to its real sales growth over the past several years, even after you adjust for the recent layoffs.
For every large, big tech company that's having layoffs, there are many small organizations who are eager to gobble those employees up. So I wouldn't say that there's a dearth right now. What we're seeing, however, Trevor, is CEOs taking advantage of fear in the headlines.
I think that these layoffs put these companies in a position where it's more difficult for them to show better than expected sales and profits. Because if they had better than expected sales and profits, why are they cutting headcount so significantly?
You're at the place where layoffs are the most likely catalyst to give Fed confidence inflation will get back to 2%.
So I expect sort of towards Q2, Q3, you'll see the margin improvements and bottom line improvements on earnings that result from the layoffs and the cost cutting, but you're not going to see it just yet. So I think it'll trickle in the coming months.
So you've had the eco data, you've had the earnings. Let's get to the macro and the earnings season at large with Alex Tapscott, Managing Director over at 9 Point Partners, the digital asset group. Over $6 billion US in assets under management, or 8 billion Canadian dollars. And Alex, it's quite the week to digest. I'm grateful to have you with me. I guess let's start on the jobs data. Really hot print here in the US for January. You know, the logic here, I guess, from the market's reaction is the Fed will have to rethink about the timing of a policy pivot. And then in the context of higher rates discounting present value, future profits, tech, etc., is this a think again moment, or is this just a blip?
Well, I guess we're back in the zone where good news is bad news. I think that the market reaction was pretty predictable given the much hotter than expected non-farm payrolls. But as you pointed out in your opening segment, you know, the market's been up 5 weeks in a row, and the NASDAQ, which is obviously highly sensitive to interest rates, is set to close up, or I should say recently just closed up over 3% for the week. So I think we were probably due for a pullback after a pretty blistering hot period. And as I see it, I don't think the number today, as one isolated data point, is enough to derail this risk-on trade that we've seen pick up the last little while.
So you yourself personally do hold Apple, Amazon, Alphabet, the parent company of Google. I think you also hold Microsoft as well. As we reflect on the week of earnings, one of the takeaways that other guests have said is that essentially this is definitive proof. Mega cap tech is not immune to what we see in the global economy. Was that your takeaway as well?
Well, I think that's been obvious for the past few months. You know, I think going into 2023, investors had really been pricing in the worst case scenario for the start of this year. I think expectations were that inflation was going to keep running hot, and that was going to force the Fed and other central banks to continue to jack up rates, and that we were going to be due at some point for, you know, some kind of economic slowdown, maybe even a major recession. So far, the data has not borne that out. Now, I wouldn't say that we're out of the woods yet, but I think that the worst case scenario is really no longer the base case. And I think a soft landing went from something that was kind of a pipe dream for a lot of bulls to something that's increasingly being priced into the market. And when that happens, I think that that's obviously going to cycle capital back into stocks. I think a lot of managers started the year very underweight, looking to wait and see how the Fed reacted. And you get this FOMO at the beginning of the year, as simple as it might sound, where they have to play catch up to make sure they don't miss their benchmarks. And I think we're starting to see that trade playing out too.
Right. There's this idea of tough comps, right, or unfair comparisons between Q4 22 and Q4 21. Apple was a good example of that in their commentary around the difficulties they had in the last 3 months of 2022, but also the idea that it wasn't fair to compare with the year, the period a year ago because of the different product release timings. You know, how good was Q4 21 compared to what we saw in the most recent earnings period?
Well, as you pointed out, every company is different. And in Apple's case, you know, the product cycle can weigh on earnings and on revenue. But I think in general, Q4 2021, so a little over a year ago, was kind of like the Goldilocks zone. You know, we had all this deferred consumer spending because people had been locked up during COVID. You had an economy that was still growing at a very fast clip, and the inflation concerns weren't quite as, you know, acute, I guess, as they are today. And so you saw that transferred into consumer spending, you know, business spending on advertising, spending on cloud, and so forth. That translates into the earnings for these companies. So I would say that looking at, you know, most investors were looking at this earnings prints from these different companies, hoping to avoid the worst. And to be clear, like tech earnings were mediocre, and I would say kind of a mixed bag. You know, Facebook beat on earnings and revenue, but had exceptionally low expectations. Apple, as you pointed out, mixed on both. But ultimately, you know, we're comparing it to a period that was, you know, if not an outlier, very difficult comp compared to what we saw last year. And B, I think that really people are trying to look forward to see what these companies are going to do to try and right the ship. And yes, please
on
go
that
ahead.
note, how zeroed in then is this market on the bottom line? When we talk about what we learned from earnings about 2023 going forward, the answer seems to be not that much, other than they're zeroed in on cost.
Yeah, well, in a zero interest rate environment, it's a grow at all costs kind of market, right? And that's why you saw, unprofitable tech companies trading at sky high valuations. And that was true also for big cap tech companies. And I think we're starting to migrate from a top line market to a bottom line market. There's an increasing focus on cost, all the inputs that go into, the financials for these companies. And as you've pointed out, there have been some job cuts and some other trimming. And I think if you look at the earnings calls for these companies the past week and a half or so, that's something that they've really drilled down on. And I think investors are pricing that in. They're thinking, okay, well, if they can keep cutting cost, even if revenue is flat, then I'm going to see bigger earnings and I want to buy into that trade.
All right, Alex Tapscott, Managing Director over at 9 Point Partners Digital Asset Group. So good to have you here with us on a Friday evening after what was a monster week for financial markets.
My pleasure.
Now, coming up, we'll wrap up that week that was in tech earnings, taking the lessons from Amazon, Google, and Apple as we look ahead, believe it or not already, to next week's earnings. All of that next. This is Bloomberg.
Is really doing quite terribly on fundamentals. So while tech companies are ripping on their stock prices, they're having an awful earnings season.
It's a pretty direct and dour assessment from Credit Suisse's Jonathan Golub on how tech's faring. Let's continue the conversation. A mega week of mega cap tech earnings. Let's get the e-commerce perspective. Rachel Tipograph, CEO and founder of Micmac, a global e-commerce enablement and analytics platform for multi-channel brands. You heard what Jonathan Golub had to say about how tech is doing. In summary, not very well. When you looked across Amazon on the e-commerce side, and also as it extends to what Alphabet had to say about core search, what was your takeaway from this week, Rachel?
Listen, we all knew this was going to be a tough week, but we're talking about the three biggest players in advertising. We have Google, we have Meta, we have Amazon. They each play a fundamental role in the ecosystem, but times are changing. With Google, they've had the stronghold on search, but they also sit on this amazing asset, YouTube, which is an incredible place for brand awareness and engagement. You have Meta, largest player in social. They've done a phenomenal job of building out full funnel ad solutions across Facebook and Meta. And now you have Amazon, the largest player in e-com, which is also another way of saying they're sitting on a treasure chest of purchase data waiting to be monetized. And what's changed in the
No, I'm sorry to interrupt you, Rachel. I want to zero in on that because this is what surprised me about this earnings report from Amazon. Last quarter, the upside surprise was advertising. And this quarter, the downside surprise was that AWS didn't come in to save the day, but we didn't really even talk about advertising. And you're basically saying that this is some unlocked or still locked up potential for the e-commerce giant.
Absolutely. AWS was an amazing way to offset margins. Advertising is an amazing way to offset margins in the losses of their traditional retail business. So Amazon's ad business grew 23% in Q4. It was now becoming a very, very close player behind Meta. And the reason for this is because of the headwinds that Google and Meta have experienced. Changes in Apple's iOS 14, cookieless internet, they started to undo the way that direct response advertising fundamentally worked in platforms like Meta and Google. As a result, advertisers want to be able to demonstrate the ROI of their marketing investments, and Amazon is sitting on all of this purchase data to be able to demonstrate to advertisers direct attribution. And so Amazon is really riding the tailwinds that are, in fact, Google and Meta's headwinds.
Let's zero in on Meta. that was the surprise of the week, probably. You know, the response, Meta's shares jumping by the most in a decade Thursday. But the other data point is Facebook at 2 billion daily users, up 70 million from a year ago. What has Meta done to make its platforms interesting again? Because presumably the market reaction is the investors saying, this bodes quite well for advertising revenue going forward.
Yeah. So the way that people measure the efficacy of their advertising dollars is through this mythical model called media mix modeling. And what it requires is that brands need full funnel marketing. In order for the math equation to work, they need to have upper funnel media that's letting people know, hey, I exist in the world, mid funnel media that's encouraging them to buy, and then bottom of the funnel media that's pushing them towards the path to purchase. Bottom of the funnel media, think Amazon, think Walmart, think Instacart, all of retail media, it's typically expensive. Upper funnel media is more affordable. Meta remains to be a really strong platform for upper funnel media. MikMak, we work across 800 of the biggest brands in the world. And in 2022, we actually saw paid traffic within Meta increase by 8%. We saw a decline in Google by 7%. And what that demonstrates is that advertisers still see Meta as an upper funnel channel. And what's happening is that people are moving dollars out of Google, because primarily that's search, into Amazon, because Amazon is the new search.
Hey, Rachel, in aggregate, what did we learn about the health of the advertising market for social media companies this week?
We're learning that people are continuing to spend. Is it the gold rush of 2020 and 2021? No. But are billions of dollars still moving into platforms like Meta and Pinterest and TikTok? Absolutely. And TikTok continues to be a platform that everyone should be watching. We saw massive amounts of dollars, again, shift away from platforms like YouTube into TikTok in 2022.
Rachel, I finally want to go to Twitter. Since Twitter's gone private, there's less fun to be had. Well, actually, that's not true at all. You can just go to Elon Musk's Twitter, which we did today. And Elon Musk is talking about sharing revenues from ads with the creators. And I'm interested in your take on this, about Twitter's pivot to a creator-driven platform. Do you think he can do that?
Listen, Elon is trying everything right now to keep dollars within the platform. At MikMak, we've essentially seen a 100% decline in paid media traffic in Twitter since he took ownership. So with creators, it's actually an interesting play. YouTube did a very similar move where they share 50% of the ad revenue with creators. As a result, many, many influencers have built six-figure businesses on YouTube, and it's encouraged them to move away from platforms like Instagram into YouTube for content creation. So I do think there's an opportunity for Twitter to engage with creators in this way, but it's not novel. It's a proven playbook that works in environments like YouTube.
All right, Rachel Tipograph, founder and CEO of MikMak, thank you so much for joining us this Friday. Now, Rivian is developing an electric bike that's potentially expanding the EV maker's product lineup. This is something I was reporting earlier today for Bloomberg. CEO RJ Scaringe disclosed the e-bike effort Friday at a company-wide meeting or all hands. That's according to my sources. A small group of engineers is already working on this project, RJ Scaringe told his staff. The company owns patents for electric bicycle components and designs. Now, coming up, derivatives traders sent back to manual processing thanks to a cyber attack earlier this week. We have the details on that coming up next. This is Bloomberg. A cyber attack earlier this week sent derivatives trading back to the 1980s. Bear with us. Joining us for more, Bloomberg's Catherine Doherty, who had that scoop. Explain the basics of this story to me, Catherine.
So just this week, Ion Trading, it's a software firm that is the key to many markets across the globe, but this specific software was for derivatives trading. And earlier, it started in Europe. Some of the systems were down, and it came out that there was a cyber attack. And ultimately, that meant that derivatives trading was upended across the world, and it's really been a disruption. And this target, which is ongoing, the systems are still down across the globe and only just now either coming back online or moving elsewhere. There's been a ripple effect, and there has also been many developments, even currently. We're calling sources because it has come out on the cyber attack, the actual attacking website, that this software is now not on their target list. So we might actually see some developments and some resolutions soon.
This is a story, Catherine, of technology gone wrong. Just terrific reporting from you and the team. My understanding is that we've had responses from the US Treasury Department and also some banks. What are they saying?
Yes, so today we put out some reporting on the banks that are either directly impacted, and what they are saying is that they are managing their trades, some of them manually. So they're going back to, we do refer to the 1980s when this world of derivatives trading was more manual and less automated, less dependent on computers and electronic trading than it is today. So they are trying to resolve this issue. They are manually reporting so that they can abide by the regulatory guidance, and the regulators are giving some flexibility as well. They've extended some deadlines, and some of their reporting requirements that are due at the end of this week have been extended.
Feels like this is just the start of this one. Bloomberg's Catherine Doherty, thank you very much. Now, the Pentagon is tracking a Chinese surveillance balloon that lingered at a high altitude over the western US. The balloon was spotted over Montana, home to ballistic missiles, and the Pentagon advised shooting it down due to the risk of falling debris. The episode prompted the Biden administration to postpone Secretary Blinken's upcoming trip to Beijing, which was due to happen next week. Now, coming up, more and more tech giants getting into AI. Google, the latest, place a bet. We'll tell you all about that one next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Ed Ludlow in San Francisco. Now, Google has invested almost $400 million in the AI startup Anthropic, which is testing a rival to OpenAI's ChatGPT, that according to a Bloomberg source. The deal gives Google a stake in Anthropic, but it doesn't require Anthropic to spend any of the funds buying cloud services from Google. It's been a long week of AI headlines, and I want to break them all down now with Sagar Shah, head of responsible AI at Fractal, a global AI provider to Fortune 500 companies across finance, healthcare, and retail. Let's start with that and Google. Sagar, you operate in the world of AI. I know that you're following the headlines and technological developments closely. You know, the executives over at Alphabet and Google were ready for the questions. When are you going to pull back the curtain? But what did you as an industry participant actually learn this week about Google's latest in artificial intelligence?
Sure, Ed. I think this is a fascinating topic for all of us. It will affect all parts of society, as we can understand. Definitely, you know, there's a lot of talk after Google's earnings report, for sure, but that also indicates a lot about the macroeconomic environment, not just about ChatGPT, right? The digital ad business going down, not growing as fast as it was last 2 years, like that, so sort of a macro trend. But the most interesting part has been ChatGPT and this investment in Anthropic, as well as the internal arms of Google all coming together, which was a great thing to see. For example, the internal arm, Lambda, which is the language models arm, right? They are now using that for the Apprentice Bard app internally to test. They've asked all their employees to start using it and sending feedback, right? That's an interesting move. The other, DeepMind, which also has, almost the best AI algorithm at 2010, right? That was a London-based company that they acquired, and it sort of become the, part of Google. They have also asked DeepMind to, get involved in this race. And of course, the Anthropic, as everybody's noticing, is just another one of those investments, which is a significant investment, still less than Microsoft's multi-billion-dollar investment in OpenAI. So I feel Google is, of course, trying to match up the speed, as well as using all its AI methods to catch up. And it's possible it may even go, better than anything else out there, considering the advances it has already made in the world of AI.
The other conversation that's kind of emerged over the course of the week is who's ahead and who's best positioned to commercialize artificial intelligence. The stock market is also paying attention, right? We look at some interesting names, C3 AI, Big Bear AI, even BuzzFeed, whose stock has been all over the place because of their relationship with OpenAI for the use of ChatGPT. We're showing just some of the jumps on Friday, Big Bear up 44%. What was your conclusion this week about who is leading in the field of artificial intelligence? Is it Microsoft? Is it Google?
That's a tough question, frankly, and I would reflect upon it in a different way. I think the race is much longer than this year. Frankly, ChatGPT, generative AI, which is the larger umbrella in which synthetic data, language models, all of these other types of algorithms are also being used, right? It is still a little far away from being where, let's say, Google search is for today. So I think it's out in the open where the competition will land. And let's say Google uses all its data, all its algorithms, all its investments towards that. And then Microsoft is doing the same if it integrates OpenAI with, let's say, Microsoft Teams and all of its applications. Will the search, consumer search, move from, let's say, Google to Amazon product searches or within the Microsoft apps? Or maybe Google will develop something much better. That's a sort of a debate we keep having every day. But I think it's a little away from the stock market. Like the stock market reactions are, I feel, quite stark to this. I would expect less stark behavior going forward because you will start seeing the improvements in generative AI. Currently, it's only, it's very infant. It still cannot be trusted to do many things. It can do basic stuff like replication of natural language and, copies, media, some, NDAs, contracts, etc. And so that those jobs may get, repurposed to something more meaningful for some people. The upskilling may be required and so on. So some of those things will happen, but it is still not going to be completely disruptive as we are seeing, at least for the next few months. We're still a little far away.
So give me then a taste of the here and now, the reality, right, and what Fractal's doing. We started this segment by saying you are providing AI right now to Fortune 500 companies. What does that look like? What does that even mean?
Yeah, so Fractal we are a set of 5,000 people globally. We're providing tech services in AI to almost 150 plus Fortune 500 companies across all healthcare, financial services, insurance, consumer goods, retail, and so on. And for us, every strategic decision, tactical decision, operational decision that a corporate person or a consumer is making, right? How can we make that better using AI? And when I say AI, it's a much broader term to us. It is AI plus cloud engineering, which enables AI. It is human-centered design, behavioral sciences, which enable user adoption. So all of those things come together to help companies make better decisions. We also have products which help behavioral sciences to solve complex problems. Like one of our companies, Final Mile, works very closely to reduce human trafficking, to reduce HIV in Africa, in Asia, and so on. And other such products which help in, let's say, training. Analytics Vidya is one of those companies which we invested in, which helps create the data science professional pool in the world. It's the largest training platform, and so on. So that is what we're trying to do with cultivating a community of data scientists who can work, in this new environment because a lot of upskilling is required in this environment. And a lot of business problems can be solved using AI, but there is always a human also required. So how we believe is people without AI will suffer compared to people with AI. It is not AI versus human.
Sagar Shah, just a really deep read on what's happening in this space right now. Head of Responsible AI at Fractal. Thank you. Now, coming up, calls are growing for banning TikTok in the US. Could it actually happen, though? We'll discuss. This is Bloomberg.
Could TikTok be banned in the US? Just over 2 years after the Donald Trump administration tried to force the Chinese parent company ByteDance to sell its US business, there are new legislative efforts to ban the social media app outright. 2 bills have been proposed, one in the House, one in the Senate, but it's a tricky issue.
Policymakers are walking a really interesting line. Of course, they want to keep American users' data safe and make sure that there's no influence from foreign governments on users in the U.S., but they also don't want to upset a really important and increasingly powerful voter base, being young Americans who are loving and finding a lot of delight from the TikTok app.
That's reflected in the mood in D.C. Daniel Flatley, a reporter for Bloomberg News, was sitting in his car a block away from the Capitol when we spoke.
You won't find very many lawmakers on Capitol Hill who are unabashed supporters of TikTok. They say that they have some concerns.
My patience is run thin. If they got a solution set, they ought to lay it out. And if they don't, I think you're going to see, if they ever get to a solution, it may be moot because individual states or Congress may act.
It's not totally clear whether they have the appetite to ban it completely, because that would be taking things pretty far. And could potentially be challenged in court. So we'll see how all that works out.
The app is already banned on all devices issued by the federal government. A number of states have followed suit, as have publicly funded universities in those states. Some have advocated using the prospect of an outright ban as a bargaining chip for negotiations with China over tech. Ultimately, if Congress fails to make any progress, it will fall to President Joe Biden to find a way to rein in the Chinese tech giant.
That was Bloomberg's Alex Webb, Alex Barinka, and Daniel Flatley. Now, let's talk a little bit more about this. Bring in Gen Z VC's founder and CEO, Megan Loist, for her take. Megan, you know VC founders, you know Gen Z tech. TikTok is an app used by, a broad demographic, but Gen Z as well. The other side of this debate is the user base. And them saying, we don't get it. We don't get the risks. We don't get why you're taking this away from us. Where do you sit on that?
I think it's interesting, right? I think there's two sort of users you have to think about. There's the people who consume TikTok content like me, and there's also the creators who their livelihoods are dependent on TikTok and their followings. So for users who are spending 15 to 20 hours a week on TikTok and it's their #1 source of entertainment, they're obviously concerned that that's going to be taken away. But for creators where they're actually monetizing on TikTok and 70+% of creators, their #1 source of income is actually through brand deals, you take away their main platform, you take away a lot of people's livelihoods. And so I think people are up in arms, especially Gen Zers who make up 60+% of TikTok's users, simply because you're taking away either our main source of entertainment or our actual source of income. And so, and again, the #1 career path for Gen Zers today, we want to be YouTubers, bloggers, content creators. And so this is going to continue to be a theme for a lot of people, and TikTok is our sort of platform of choice. So, and on the founder side as well, you see a lot of consumer founders scaling their businesses on TikTok. It's a great path for distribution and building an authentic, organic presence versus doing a lot of paid marketing. And so you're actually taking away a lot of opportunity from founders as well.
Right. Colloquially, Gen Z is anyone born in the late 90s through, I think, until 2010. So that's a pretty wide group of people that we're talking about. I'm interested in Gen Z VCs, the kind of community that you founded and started, because it is an ecosystem of both founders and VCs. And the other debate that we want to have you on to talk about is how those people will fare in 2023. Our colleagues at Bloomberg Opinion, Alison Schrager, wrote this column this week titled "Gen Z Startups Will Face a Tough Sell in 2023. In other words, they're entering an environment where they're trying to raise money, get businesses off the ground, but the world's changed. What are the conversations you're having right now with the community that you founded?
Yeah, well, I think the funding environment is difficult for younger founders and older founders. The average age of a founder is about 35 years old. And I understand the conversation with investors where it's like, okay, maybe there's less risk in backing experienced founders who have done it once before. But on the flip side of that coin, there's a generational opportunity in backing Gen Z founders who are building problems for themselves. And you see this with every generation. It's not something that's necessarily unique with Gen Z. But it's really important because when you look at the world today and the problems that we're facing and experiencing, Gen Z founders have naturally, they experience the pain point firsthand and they can build around that problem. Even for me as a Gen Z investor, and formerly I was an investor at Lair Hippo, General Atlantic, large funds, I tended to back first-time founders, Gen Z founders, because I intimately understood their take as an investor. And so what I'm seeing broadly is it really encouraging founders to go back to the fundamentals. And so thinking about their unique value prop and why they're building the problem, what makes them the best person to build that business. Really just thinking about founder market fit, which is true for Gen Z founders, millennial founders, Gen X founders, any founders. And so I think, broadly, I think there's still a massive opportunity to be backing Gen Z founders, young people who see problems authentically from the Gen Z perspective.
Megan, when you look at opportunities yourself as an investor, I know you back a lot of Gen Z founders. What are thematically the areas you're most excited about in 2023? We just have 30 seconds.
Yeah, so we actually do a poll every year. This year, the top 3 trends that Gen Z investors are tracking are climate tech, AI and ML, which is a very sort of hot topic right now, and then fintech as well. So those are 3 areas that we're tracking. And even just this week, I've been pitched in a bunch of generative AI companies. And so a lot of younger founders are building in AI broadly.
Gen Z VC's founder and CEO, Megan Loy, so great to have you on the show. Thank you so much for joining us. Now, coming up, the indoor cycling phenomenon. And no, we're not talking about Peloton. Stay with us. We'll explain a bit more. This is Bloomberg. When you think of indoor cycling at home, you probably think of Peloton, but there's a new kid on the block, Zwift, which some cyclists use when they can't ride outside and which takes you, okay, bear with me, inside the metaverse. Quick Takes, Tim Stenovic took a ride with the company's co-CEO, Eric Min.
Oh, there you are. Now I got to catch you. And I'm chasing you now. Where's the sprint? That's what I'm waiting for. Yeah, you left me in the dust there. When it comes to indoor cycling, pretty much everybody's heard of Peloton. But Zwift is what a lot of the serious cyclists use when they're just not able to ride outside. Here's how it works. A smart trainer connects to apps and it can adjust to make it harder, like if you're going up a hill. One of those apps is Zwift. It helps you exercise, but it's also a game. You're pedaling your bike in the real world, but you have this avatar. I wanted to learn more about Zwift, and I thought there was no better way to do that than to go for a ride with the company's CEO. I'm in New York City. You're in Long Beach right now. We're, 3,000 miles away, but we're actually riding together on screen. Is this the metaverse to you?
Absolutely. It's the metaverse. It's a virtual space where people come together, they engage, they build communities. If you look at the clubs that we have well over 20,000 clubs. It's really interesting, and the power of the community is, I think, unique to Zwift.
How do you develop courses? What's the process there?
We have a fantastic creative team. And what we've learned that over the years, these magical places like Watopia and now Makuri Islands are the kind of maps that our community would like to spend more of their time on. And that's partly because we can do crazy things, right? We can create tunnels under the water in the seabed. We can create roads above Manhattan. There are other people who can try to replicate and be more of a simulator. We want to be our own thing, and I think we can enhance what the real world is and just make it much more interesting. Do things that you otherwise can't do.
We see a lot of companies raising prices right now because of inflation. Am I correct in thinking that you guys have not raised prices?
We did raise prices 5 years ago, but we have not done so since then. But let's be honest, the cost of running our business has gotten more expensive. It's been really tough. The supply chain issues are real. We are trying to run a business that is profitable at some point. It's not at the moment. We're really focused on trying to onboard as many customers as possible and trying to make the pricing accessible.
You've raised over $500 million. Your investors want to see a return. What's the exit for them?
I think we all have aspirations of taking this company public. There's no doubt about it. Our investors have invested in this business because they think we will be the category leader. We believe we can do that through product.
Take us into the decision to launch Hand Cycles and tell me about the reception and what you've heard.
Back in September, we finally launched the Hand Cycle. It's available to everyone, but those who are using it are really those who are disabled. This is really about, living up to our values, which is about diversity and inclusivity. We have some responsibility in making sure we make those investments.
What's the breakdown of Zwift, male versus female?
It's 80% men, 20% women. So there's a lot of work to be done there. And this is why the sponsorship of the Women's Tour de France is so important for us.
Take me through the ROI on that. How does that translate into more people, paying $15 a month for Zwift?
If you're going to sponsor a bike race, you sponsor the Tour de France. So when the opportunity came up for us to really help support and relaunch the Women's Tour de France, we jumped at it. We'll have to find a sprint to do.
That was fast. I feel so bad. I'm throwing my colleague my sweaty towel. You used to work at a bank.
Yes.
Now you ride bikes all day.
I started my career on Wall Street many years ago. One of the inspirations for starting Zwift was to recreate my community, my experience, the competition, the training that I had in Central Park.
What does Zwift look like 3 to 5 years from now?
I think there will be a convergence. It's our job to make the interplay between indoor and outdoor as seamless as possible so that what's not lost in that interplay is the social connection and the ability to share experiences. I think that is a big unlock for how we can really contribute to the cycling industry.
I've never done anything like this before in terms of interviews.
I've not done this before either, but I'm told that there are some tech leaders who, on a monthly basis, get on Zwift and have their catch-up calls. I think they find it amusing to be able to do some exercise at the same time.
All right, Eric, I'm going to catch you.
Oh, here we go. Okay, that's enough for me. That's my workout for today.
Virtual high five.
That was great.
Thanks, Eric.
Awesome. Thanks, Tim. Let's do it again.
Yeah, let's do it again. I would love to.
Quick takes, Tim Stemenik there. Some breaking news on the Bloomberg terminal. Elon Musk has defeated the Tesla shareholder suit on the 2018 tweets about taking Tesla private. The jury's found that Musk did not mislead the public about the Tesla take private deal. We'll have more on that in the coming days. That does it for this edition of Bloomberg Technology. Don't forget, check out our podcasts, iHeart, Apple, Spotify, wherever you get your podcasts. What a week. This is Bloomberg.